Hello and welcome to our latest Insider interview. Today I have with me Gervais Williams, Fund Manager of the Diverse Income Investment Trust. Gervais, thanks for coming into our studio today.
It's a real pleasure.
So Gervais, you invest across the UK market in large, mid and small cap, as well as having exposure to AIM. So what's the current split? And how has the portfolio fared this year?
The underlying feature of the fund is we invest for companies which generate good and growing income. And the underlying good and growing income within the fund has continued to come through just as we expected. Clearly, valuations have come down considerably, not just the mainstream stocks, but as you mentioned, many of the smaller quoted companies, the AIM-listed companies. The fund has about a third of the fund in AIM-listed companies, income stocks, which are generating good and growing income. It's probably got about 25-30% in mainstream FTSE 350 companies and the rest in other companies. So it's quite well spread across the different areas, but the NAV has come down quite a bit this year relative to other funds which actually tend to invest in the very largest companies which have held up much better.
And going forward, how would you assess the valuations of the underlying companies today?
Well, what's interesting is the underlying companies themselves continue to report relatively good profits. They continue to grow dividends, which is important. And one of the ways of looking at valuations is to look to the price, the assets on the balance sheet relative to their market capitalizations. And these have fallen considerably. It's very unusual to see a price to book ratio below 1. The fund is currently standing on a ratio around 0.8, which is incredibly low. And hopefully, if these companies continue to succeed, there's plenty of recovery potential in the future.
And that valuation measure, the price to book that you just mentioned, how does that compare over the 10 years that the trust has been in operation?
That's right. I mean, if you look at the mainstream UK market, it's about 1.5. If you look at some of the US assets, they're over 4, 5, sometimes 6, although they've peaked out now. So the valuations in the UK are low in themselves. The valuation of the fund is unusually low. Normally it's around the average of the UK stock market. As I say, it's well below that at the moment, which is really very, very unusual in our case.
You have a put option in place on the FTSE 100 index, which seeks to profit from when that index falls. Is that put option still in place? And I assume it's not a position that's paid off this year?
That's right. I mean, we have had a put option in the past. We had one in the end of 2019, going through the Brexit period. What happened, of course, with 2020, we had the pandemic in March 2020. As the FTSE came down to about 5,000, the value of the put option rose. It's only covering 40% of the fund, not 100%, but it meant that the asset rose to become a multiple of the original costs. It wasn't so much that it protected some of the asset loss during the period of setback, but most particularly it meant that we could take profits and reinvest that cash in new holdings at low valuations for greater upside potential. Now, after the March 2020 pandemic period, the cost of the put option was too high. And for the following 1.5 years, we didn't have a put option because it was just the cost of its decay over time. If it doesn't come through, then it ultimately detracts from performance, was just too high. We have actually had the put option back in the portfolio for just over a year now. Yes, it has cost money. It's cost a bit over 1% in the period since we reinstated it. It was due to expire at the end of this year, 2022, December 2022. And in the last couple of months, we have extended that term through to December 23. So what it's there for is if the markets get really unsettled, if the FTSE doesn't hold up as well as it has up to now, then like the March 2020 pandemic, then it will start to rise in value. Clearly, the other 98% of the fund is invested in companies which are generating income, good and growing income. And if the markets do recover, if small companies outperform large companies, if the UK itself starts to outperform versus international stock markets, then of course the put option will expire worthless, but the rest of the portfolio will continue to deliver hopefully very attractive returns.
And given the sell-off that's taken place amongst UK smaller companies this year, has this thrown up plenty of buying opportunities? What have been the newest names to enter the portfolio?
Yes, I mean, valuations come down considerably, and the opportunity to buy companies at what we consider to be much lower and attractive valuations has been really excellent. Strange enough, we haven't needed to buy many new holdings. We're very excited by the companies we've got in the portfolio, the range of companies. We haven't really got involved in this recovery potential from the consumer sector. It's still fairly lightly invested in consumer sectors. It's invested the right way across other parts of the market, perhaps including some of the oil companies, including some of the companies involved in financial sector, which is the largest sector in the portfolio. We've been able to top up some of those holdings rather than buying new holdings for the portfolio because they themselves have come to low valuations, and we believe actually they're some of the best companies out there in terms of recovery potential as well.
Could you give us some stock-specific names of companies you've been topping up that you were already part of the portfolio?
Yes, I mean, if you look at, say, one of the advantages of things like the construction industry is they tend to have quite long order books, and so it doesn't matter quite whether the forthcoming UK recession is slightly shorter or longer than people think. So, for example, of that, a company like Galliford Try is in the portfolio. What's unusual about Galliford Try isn't just that it's generating profits, it's paying dividends, growing quite nicely, it's got a very big order book, but actually its valuation in the UK stock market is below the cash balances on its market capitalisation. So its cash balances exceed its market capitalisation. This is a most unusual feature about companies in the UK. One, it means that hopefully the company is resilient, and if there are setbacks, it will be strong. But most particularly, when it does generate surplus cash and it is able to pay dividends, it can pay not just good dividends, but grow its dividend rate at a much faster rate. So there's a company, for example, on a P of less than 10 in the portfolio, which we're very keen on. Another example might be Kenmare, which is a business which is involved in titanium dioxide. It's got a mine in Africa. It exports titanium dioxide around the world. About 7% of the entire world's supplies, used mainly in the paint market. It's the whitening agent in paint. Clearly, paint is likely to be a stable market. Again, it's trading very strongly. It's made a lot of profit. It's paying a very attractive dividend. Valuation of less than 3 times PE ratio, according to Bloomberg. But most particularly, again, the share price hasn't really moved. So these companies are, in our view, extraordinarily overlooked. And if anything, there's a great range across a great range of different sectors to diversify risk. So these are the kinds of things which we think are not just attractive at this point, but actually hopefully will deliver not just good dividend growth, but particularly good capital appreciation from here.
And while share prices have been volatile this year, dividends have held up well. Could you give a couple of examples of dividend companies you own that have increased their payouts this year?
Yes, I mean, one of the largest holdings in the portfolio is a company which is involved in K3 Capital. It's a portfolio holding which doesn't just help companies, it buys and sells companies for small buyers and sellers. So effectively, it's like a corporate finance house, but not for the mainstream, for the tiniest companies, unquoted companies in the UK. It's trading pretty strongly. It also has an insolvency practice in there. Obviously, that's good news. And so it's increased its dividend quite substantially. It issued some shares back in July, I think, 2020, at about £1.50. This year, it's paying out a dividend of 15.5 pence of dividend. So effectively over a 10% yield. Clearly the share price has gone up, but these are the kinds of opportunities. It's grown its dividend beautifully over recent years. Good and growing income is the cornerstone of the fund, and that's what we're looking for.
Diverse Income has a dividend yield of around 4.5%. Now over the past year we've seen interest rates rise, so the amount of income that cash is now paying is a lot higher than it has been for several years. Bond yields, they've also been on the rise. So they're at much more attractive levels than they have been again for several years. So how would you try and convince an investor to back equity income rather than cash or bonds?
Yes, I think one of the features of the recent couple of years is we've seen inflation come up again. I think it will peak in the short term, but I think inflation as a problem was going to be with us for quite some time. And the disadvantage of fixed income, of course, is that they're fixed income. When you've got inflation, they don't go up with inflation. The great advantage of investing in companies is their sales tend to rise with inflation, which means that their income, if they continue to succeed, rises with income. It's the good and growing income which we believe is going to be not just attractive now, but actually going forward. We think the UK equity stock market is going to become more important to all asset allocators who want to invest cash compounding rather than just capital appreciation. So it's the cash and the growing cash from the portfolio which is the cornerstone and the reason why we think there'll be growing interest in the sector.
Gervais, thanks for coming into our studio.
Thank you very much indeed.
That's all we have time for today. You can check out the rest of our insider interviews on our YouTube channel, where you can like and subscribe. Hopefully, see you next time.